Hey, welcome to the Inner Circle podcast, where growth minded leaders come together to build better businesses and better lives. I'm your host, Hector Alvarado. Here, we don't do theory, we share real lessons, real systems, and real strategies you can use right away. This is a community for people committed to growth, impact, and supporting each other on the journey. You're in the right room, my friends. Let's get started. Welcome, everybody. Again, week 3 of the Scalable Business Blueprint. And one of the things that really is intriguing to me, as you were pointing out, Alan, is that everybody's excited to talk revenue. Everybody jumps into that conversation. But the moment you put people on the spot and ask about profit, man, everybody scatters, right? It's like, yeah, it's not like it's like you're bringing up politics or religion. Nobody wants to talk about it, right? And so it's interesting because the reason why this happens is because there's an old saying, and it says revenue is vanity, profit is sanity, and cash is reality. And everybody wants to avoid talking about reality because it makes them uncomfortable to express the truth about their businesses. Nobody wants to talk about profit. They just want to talk about that. And I'll tell you that phrase, although catchy, it's the gospel truth in the world of business if you absolutely are serious about being successful as an entrepreneur. And I'll tell you a story. I once met this entrepreneur, this sharp guy, who was doing $2 million in revenue running a service business. And it was impressive, right? You thought he'd be living the dream. But when you asked him how much he actually took home, it was $47,000 a year. I'll never forget this. I actually couldn't believe it. And it was shocking, but what's worse is that I've actually seen this over and over. I've seen entrepreneurs that have $5 million a year businesses and they don't even pay themselves yet. And there's a reason for this. It's because they don't truly understand how to optimize your business and how to truly understand what is wrong with the business. He and many like him had optimized for revenue and not profit. He, like many other entrepreneurs, had celebrated those big revenue milestones, right? You hit 100,000, you hit 500,000, you hit a million, 2, 3, 4 million, and you're celebrating. You're like, yeah, yeah, yeah. Well, while your margins are quietly being eroded, you add clients and you add people, but you don't understand unit economics. And that is how so many scale unprofitably. So here's the truth. So you can absolutely grow yourself right out of your business. I've seen it. Willy can attest to it. He's lived it. We've all seen this happen. And why it occurs is because revenue without profit is just expensive, busy work. It's like running on a treadmill. You're moving a lot, but you're not going anywhere. So you have to fix that. And that's what we're going to talk about today. And there are 3 lies that every entrepreneur tells themselves. And so we're going to expose those lies, or we're going to talk about the truth behind them. The first lie is, I hear this all the time. If I just get to X amount in revenue, everything will be fine. Right? And that's the old thought that you could sell yourself from a bad situation. Well, the truth is you can't. Profit margins matter more than top line revenue. $1 million in sales with 0 profit is just garbage. Right? What are you doing it for? Like, there's no point in doing it. I've seen it. I've seen it time and time again. And so exposing these are the first step so that everybody here can get to a sense of comfort with talking about profit. Line number 2, I'll figure out profitability later. Grow first. That's so common. Well, the truth is unprofitable growth doesn't just go away. It compounds at every level. And the problem just gets bigger and bigger as you scale because it compounds. It's digging yourself into a bigger hole through every new customer acquisition that you insert to your business. And line number 3, revenue is the scoreboard that matters, meaning it's the KPI that I need to be aware of. It's the only thing I'm looking at. The truth is, cash in the bank, my friends, is the only true number that truly matters. If you can't pay your team or your bills with revenue on paper, then you need a wake-up call, because I've seen it like many times. In fact, there's some of you on this call that I know I worked with you, and you're currently in that, in that stage where you're saying, man, I can't even make payroll. I got to have cash flow tactics to make sure that I'm able to get there on time. I know, because I hear it and we've been talking about it. So let me give you a scenario just so that we understand where we're going today. Business A, $5 million in revenue, 5% net margins, which equals to $250,000 in profit, right? Easy math. Option B, $2 million in revenue, 20% net profit, but equals $400,000 in profit. So 20% net margin and $400,000 in profit. Most entrepreneurs will be driven by ego and will tell you they want business A.
What was business A? Business A again?
Business A is $5 million in revenue and 5% net margins, right? And the second one is $2 million in revenue, 20% net margins. But all they're hearing is the revenue number. And so they will automatically chase that bigger, shiny object. But business B makes more money, probably has a better work-life balance, right? And is worth far more as a valuable asset than business A. So the point here is to show you, how do we change your mindset to be on the lookout for business B every single time. And it doesn't mean that you're looking to stay small. What principles we need to learn is, how do we scale smart? How do we scale profitable at every level? You get to 2 million and you have 20% net margins. You want to go to 4 million? Great. But stay true in your process and in your cost management that lets you scale smart. Don't just add all the revenue on top of it and then dissolve your process and systems, because then you'll erode your profit margins. And that's what we're going to talk about today. And so how do you do that? First, you have to understand 5 key numbers that every entrepreneur must know daily, at a minimum, really, like weekly. Because if you don't, you won't know how to truly calculate real profit margins, and you'll be guessing. And you won't truly understand how to build unit economics. So we're going to talk about how to actually do that. So I can tell you a story, and I know some of you have heard me say this. Willy, we know it because we lived it back in the early years of Willy's Trucking, when it was losing a lot of money, and we sat down in the boardroom and we had a review of the financial statement, and it was another quarter where we lost a significant amount of money. And the first pushback that I remember speaking out about was saying, folks, like, how can we be reviewing data today that is months ago for activity that happened 3-4 months ago? There's no way that we can action this. There's no way we can talk about it. So we have to fix the timeliness of the data so that we can then build the right review model for us to go and work on. So let's dive into that. The 5 critical numbers that your business dashboard must know. Every entrepreneur knows their revenue, right? Everybody, sort of. They know it. They know how much they're making. But they're vague on the idea of expenses. They only hear this when you're sitting down in front of your accountant, or when you're sitting with a leadership team reviewing your P&L, if you have a large enough organization that you have that sort of process in place. Most don't. They just have a monthly statement that they get from their accountant. So here's your 5 numbers that I want to introduce to you that you need to go start learning. First one is your gross revenue. This is the total money coming into your business before any expenses are taken out. It's your top line. We talk about it. We understand this. Now, why does this matter? It's the directional indicator of whether your business is trending up or down, right? It gives you your sense of effectiveness, and tells you if your sales team's performing and if your business is actually on track. Okay. Now, that's the first number. The second one is gross profit margin. This is your revenue minus your cost of goods. And you'll hear me and others refer to this as COGS. Okay, that is your cost of doing goods expressed as a percentage. Think of COGS as the direct cost to deliver your product or service. In essence, that's what it means. This could be in a product business, your inventory, your materials, your shipping. For a service business, this is your direct labor, your contractors. Okay, the formula is quite simple. It's revenue minus cost of goods, so your COGS, divided by revenue times 100 equals your gross profit margin percentage. Okay, that's the second number. So let's break it down for you to understand it. Let's say you have $100,000 in revenue and your COGS, your materials, delivery, all that expenditure is $40,000. Your gross profit is $60,000, making your gross profit margin at 60%. Okay, this is critical. It shows you your core business model is viable. And what's important to know once you have this number is secondary benchmarks for your specific industry. Don't just be happy with the number that you have in front of you. Go out and understand what is it in my space. As an example, if you provide a service, right? If you're a service-based industry, generally these are running at 40 to 60%. If you're a SaaS, a digital company, a one-on-one business like a consulting firm, and or like I know Peter here who sells insurance, right? You generally want to be at an 80 to 90% gross profit margin because your operating costs, your COGS are going to be much smaller. So that's critical for you to know this. So you can benchmark it to your specific industry. Number 3 is your net profit margin. This is what's left after all expenses are paid out. Again, expressed as a percentage. This includes your COGS, your overhead, your rent, software, admin, marketing, sales, all the other stuff, some P&Ls. Put this together and they express it as administrative costs. Okay, this yields your net profit. And that's important because you want to understand what's left after it's all the expenses are done. And it gives you an indicator of where else you're spending your money. So the formula is net profit divided by revenue times 100 equals your net profit margin as a percentage. So again, I'm going to give you an example. Using $100,000 revenue, $40,000 is your COGS. Now you add $30,000 for overhead, $10,000 for marketing, $15,000 for salaries, all of those administrative expenses. Your net profit is $5,000 when you subtract all those numbers, giving you a 5% net profit margin. Again, benchmarks is important for this as well. Don't just go with the number that lands and be like, oh, this is good. What's interesting to me is that most business owners have this misconception that a double-digit net profit margin percentage is healthy. They'll tell you, oh, I want to be at 10%. Just without knowing. They just tell you it's 10%, but they don't benchmark it to their industry to understand what is that industry doing. So as an example, something that is critical is that you find benchmarks that are truly healthy to be between 15 to 25%. That's what you really should be looking at. And then on top of this, it's the understanding that 10% and under is complete danger zone. You can't scale. You cannot grow your business if you're below 10%. It's going to be nearly impossible. You will hit cash flow challenges, which is what we'll talk about next. But what's worse is I see some companies that are operating at less than 10% and usually around like that 5 to 8, and that's unsustainable. That is going to be dangerous very quickly. So understand that you have to benchmark it to know whether you're in the world of sustainability and then scalability. Number 4, as I alluded to, was cash flow. Okay, now this is where every entrepreneur that I've come across trips up, because you can be profitable on paper but completely out of cash. And I actually literally just went through a quarterly review with an entrepreneurship group where on paper they yield a really nice, healthy profit, but we're completely out of cash. And you might say, well, how does that happen? Accounts receivables. That's the key section here. You're billing clients, but they haven't paid you yet. So you report it as revenue in your statement, but you don't have the cash in the bank. So it's not real money. It hasn't landed. However, you still have real expenses. You still have payroll every 2 weeks. You still have materials to go through. You still have licensing, internet. You still have all of your expenses that have to come out. And where do they come from? Generally, a line of credit. That's not real money, right? And I know a lot of businesses live off of line of credits, and they eventually will run out of cash. So knowing and understanding your cash flow is critical, and where you want to be is important. You want to understand you want to be 3 to 6 months in the bank. Now, that's ideal. I know not everybody can get there, but it should be a goal of yours to get to 3 to 6 months of cash in the bank. Because it's like that old saying, right? You're saving towards a rainy day because you never know when that rainy day could come. And your fifth number is unit economics. That's understanding your profit per client. Now, how much profit does each individual sale or client actually generate? For a service business, it's that average client minus your average cost to deliver. Now, I'm sure Peter, because he's into this in a specific to one-on-one sales, will be dialed in on his profit per client because he's going to get paid out a percentage for every deal that he makes. And Bryson, I'm sure that yours is somewhere in the same line. These are critical numbers for unit economic business bases like one-on-one services. When we're doing these type of consulting, is exactly the same thing that we're looking for. But it's not just meant for these type of businesses. You have to know, especially in service businesses or product businesses, what is that cost per individual. So it's important for us to understand it because you need to know what truly makes you money. And the problem I see with so many entrepreneurs is they try to sell everything to everyone. They add products and services without truly analyzing the profitability. I see this, we saw it even at the trucking company. You can get mixed in this. You could try to be the LTL carrier. You can even try to be the full carrier. You could be a courier because you try to provide every single service, but you don't understand that every one of those offerings drains and has a different level of profit output. And I remember the day when Willy did the analysis and he said, look, we got to stop doing full loads. It makes no sense for us to do full loads. Let the other guys do the full loads, because every time we do a full load, we need more equipment, which costs more money. We need more people, which costs more money, and we only get paid a set amount. It was like, I don't remember if it was $1,800 a load or $2,000 a load, but it was a flat rate on that load. But then he said, look, on a dry van, LTL or less than truckload, we can fit in 200 shipments at 100 pounds per shipment, right? We could be making $10,000 on that dry van load with our costs staying the same and our profit improves. So let's go after that. And that was a pivot point at Willy's Trucking again. And so similarly, same applies to service businesses. Some of you may be saying and wanting to do everything because you want to capture the market. But that may not be the necessary or best strategy for you. Okay, and I'll give you an example. Website marketing agency that I came across while doing some of this work. It was funny. It had $15,000 in revenue. Okay, so give you some numbers again. $15,000 in revenue, $3,000 in COGS, $12,000 gross profit, so 80% margin, right? Like, sounds pretty good. Takes them 80 hours to do web designing. That's a cost of $150 an hour of revenue. Now, that's a servicing that they were offering as a marketing agency. The second service they were offering was an SEO retainer. That was $2,500 a month reoccurring revenue. It had $500 COGS, $2,000 gross profit with 80% margins. And it took 10 hours to do so. So at about a $200 per hour revenue. And then their third offering was social media management. $1,500 a month, $800 in COGS, $700 gross profit, but 47% margins. And it took them 15 hours to get the work done, to do the social media management piece, giving them a rate of revenue or profitability at $47 an hour. So when you think about it, marketing agency, 3 different offerings, but the insights here is that the social media was the lowest margin as an aggregate, and so therefore you have to make a decision. You either raise your prices on that offering or you don't do it. Simple. You don't do it if it's not going to make you money, right? Like, I don't know unless you're a non-profit organization, why would you? But understanding those numbers is critical for you to be informed and make decisions on data. Now, I'm going to flip the script when it comes to profit. And I was talking to Alan and Willy about this just before the call. It's something that I had not really heard of, but it's a principle that is changing in accounting today. And it's called the profit first methodology. And it's geared to guaranteeing your profit first. And it's revolutionary because it flips the traditional accounting on its head. Ah, you got it. There it is. That's so cool. That's awesome, Bryce. It is so neat when you think about this, because traditional accounting tells you revenue minus expenses equals profit, right? And so the translation is quite simple. Spend everything and hope there's profit at the end. That's how we've all been taught. That's what we've learned. However, this profit first method tells you revenue minus profit and then expenses. Translation, go set your profit goals first. If you say to yourself, I want my business to have 20% profit. And so you have your revenue, subtract your profit, you lock it in an account, and then you have your expenses to pay. Now, here's where it becomes challenging, though, because you might be sitting here saying, well, I can't operate my business. I don't have enough money left over. I need to tap into that savings. Wrong. That's not what you do. You find a way. You find a way to run your business lean. Find a way to cut your overhead expenses. Find a way to cut your tech stack. Find a way to remove waste in your business, because that's the mentality that keeps you efficient long term. And as you scale, remember as we talked about that $2 million business that had that nice gross profit at the end, if they want to go to 4 million, well, now they have the formula that's going to allow them to get there, right? And now the magic doesn't happen overnight. I can tell you, because without knowing this system, I actually been applying it for years, but I look at it I go into organizations, I look at it from an overhead activity perspective, and I organically go in looking at where can we remove waste. That's my first agenda, is how do we make this lean as a business? And at first, it can scare some entrepreneurs. I'll tell you, because Willy and I, we had these conversations many years ago where he said, and we sat down and he was like, this is too rigid. This doesn't work. This is going to shake up the business model. But it needs to happen on a long-term scale. It doesn't happen overnight. And it's consistency that lets you get there. But the way I like to describe it is that first month, you'll probably think that there's no way you can do this. In fact, you'll be really, really concerned whether you can make it happen. You may have to be cut. You may have to cut some contracts that you found were really good to have, but you later recognize that they were not needed. Right? You may have to let go of some people that you thought were absolutely necessary for your business, but then later recognize that you really didn't need them. They were just overhead expenses, right? And all of this with the mentality of cutting fat and getting lean. However, by the time you get to month 3 and month 6 and 1 year into it, and the data starts to show you the profit, you will become energized, you will become motivated, and you will be now living and expecting your business to run this way. It will be challenging everything that you do, and you will be engaging others in your business to think the same way, because the psychology is so powerful. When your operating expenses account is the constraint, you'll find ways to operate within it. And when there's no constraint, your expenses are indefinitely. You just spend, and you just think that outselling it will do the job, getting more revenue in. But profit first limits that available revenue and forces efficient operation, which is, yeah, what, like, I truly enjoy that methodology. And so I was really excited to see this week as I was doing some research. I had not come across it. I didn't know it had a name. I didn't even know there was a book. So I learned something today, which now I'm gonna go read that book. That sounds really cool. Now, here's a first challenge for the entrepreneurs and leaders in this room today is, can you operate your business on half of your current operating budget? If not, that's okay. Nobody, like, you don't have to do that dramatic of a cut. However, can you cut 10%? Can you cut 20, 30%? Start looking internally at the money you're wasting and applying a profit first mentality. Simply, it's like calorie counting when you're going on a diet, on a deficit, right? Looking at what you can cut, but being completely focused on that and being direct on that's the outcome. Now, that's great. We got it. We got a strategy, but how do we get there, right? We have to put together a dashboard that is going to give you a glance at the problem. And this is what I was alluding to earlier. Most entrepreneurs fly blind. They operate without consistent data and or relevant data. So you have to learn that your numbers and your dashboards are critical. It is something you have to establish. And I'm going to give you 5 numbers. 5 numbers is all you need. You don't need a whole P&L to make this complicated for you. All you need to do is know your indicators. And the way that we describe it with Willy when we work with companies is we say, if you were in an island today and all you needed was 5 numbers for you to know if your business was on track and doing well, what would they be? So I'm going to give them to you. The first one is cash in bank. Know your current cash in the bank. What's your balance? Every single day, every single week at a minimum. Because that's your cash flow lifeline. That's your air that you're breathing. The second number is revenue this month. Understand that this revenue is fluctuating. So you have to have a current goal for that week and for that month so that you know whether you're on track. Just because you have a bad day doesn't mean that you're, off target. You want to measure this through weekly activity, so that it really gives you a wider view. The next number is your gross profit margin. Again, like we talked about earlier, understanding your gross profit numbers. Fourth number is your net profit margin. And understanding this currently, so month to date, is super important to know your expenses month to date, because that's what's yielding out your net profit. But if you flip it over, right, you're going to know that if you're putting profit first mentality, you're going to get that number, like paying your collectors first. You're going to pay yourself first as a profit, and then you're going to monitor the rest. Okay. The fifth number is your accounts receivable. Now, this is important. You're going to want to measure this in aging days group, 0 to 30 days, 31 to 60 days, and over 61 days. Anything above 61 days, folks, it's a danger zone. Do not live there. And I know I've heard about this from some of you already, that in some communities, you live there and it's okay. I get it. But once you expand outside of that, you need to understand these principles, because you don't extend credit like that openly. Not in big cities, not generally. That's not how it's done. So make sure that you understand those critical numbers. Now, how do you build this? It's simple. You could start off with a Google spreadsheet and just start tracking these numbers every single week, every single month, and have your team like populate this. And if you're a solo entrepreneur, get the data yourself, get talking to your accountant who's doing your numbers, and have access to this. Ask to have it so that you can track it. And option number 2, now this is a bit biased because we offer this program, is called the 90 tool that comes within our Compass program. And it's a digital dashboard that helps you in-house all of this. And once you have it, you're able to track activity daily, weekly, monthly, quarterly, and it's all summarized for you, running in a 13-week trend. And so it gives you a lot of insight. So that's how you get to it. Those are your 5 numbers. You put it on a dashboard, and then it's time to get into action. So here's your action for this week. Know your 5 numbers, calculate your gross profit margin, right? And then check the cash in the bank, calculate your month's runway, and understand you have enough money there to survive. Run your unit economics on your top 3 offerings. If you only offer one service, fine, understand how profitable it is. But if you're doing, 10 services, etc., like an X number of services, run it on your top 3 and figure out what the revenue per unit is and the cost per unit, all the way down to profit per hour. And then you're able to really understand which are the services you need to grow and scale, and which ones are the ones maybe that you need to park. Maybe which ones are the ones that you don't need to do, or raise prices on those, right? You have 2 choices to make when it comes that way. So here are your takeaways for today. Okay, revenue is vanity. So forget talking about revenue. If you're sitting in a room full of entrepreneurs and all they're talking about is revenue, man, ask them the tough question. Be like, love your revenue number, bro. What's your profit at? I need to know if you truly are a business person or if you're just here, showboating your Rolex. Like let's talk about it if you actually know your number, okay? Because cash is reality. Second, know your 5 numbers. We gave you those today. You can't manage what you don't measure. So if you're running your business without understanding those 5 numbers, my friends, you're going to run blind. You're not going to get there. And unit economics reveals the truth. As ugly as it may be, it's the truth. But that gives you an opportunity for you to go fix it. So understand your unit economics, because you can't be offering services that lose you money. You just can't, unless you're operating again as a nonprofit organization. You can't do it. And remember that profit first methodology. I think it works. I think it's amazing when you actually put it into practice. I didn't know the concept. I've used it again, working through the middle and shrinking first versus that saving first mentality. But now that I know it, man, I'm going to be applying that like crazy. And number 5, understand your CEO dashboard. Get your 5 numbers into your dashboard tool, spreadsheet, however you want to calculate it, but start to do it every single week, every single month, because data beats gut-driven decisions. If you're making data-based decisions, you're staying true and you're making decisions the right way, okay? Next week, we're going to talk about what it is like to really run your business with true leadership and a true operating system, right? That's the final piece of where we're going at next week, and we're going to bring it all together. But for this week, I want you to ask yourself, what's one decision you'll take this week to improve your profitability by at least 5%? Go do that. Go work on that, whether that's raising a price or killing a product that's losing money or cutting an expense, but don't sit idle. Pick something that we've discussed today and go look to reduce your cost by 5%. So that's today's topic, folks. And I'll pass it first to you, Willie, to maybe share some insight in your experiences as we talked about profitability. And then we'll go around the room.
One thing here I thought about was when we went through cutting all our fat out and seeing where we're at, and then unit economics again, cutting out what isn't profitable. There's a lot of power behind that one, where once you find what is actually working in your business, and you get now more niche, and now you get to become the expert of that niche, and now you can charge more. That's where the power is once you have done this exercise, and you can now up your rates on that niche and be the expert at it, at doing it.
Absolutely, because people will they'll be paying that price because they know you can back it up. You have the receipts to show.
Yeah.
Excellent. Any of those bring back memories for you, Willie?
Oh, absolutely. Some pretty hard times that we were trying to figure this all out.
Yeah.
And and yes, and many days or many hours in the boardrooms trying to really understand our numbers, because for us it was like we were doing 15 million plus in revenue and losing money, and then And then we had almost 100 employees. So there was definitely a lot of different moving parts that had to be figured out.
Yeah, yeah. I'll never forget the one example that you uncovered one time with the employee that was doing filing. Remember,
Yeah.
you mentioned this. For those of you in the room that haven't heard this story, why don't you share it, Willie? Because it was an eye opener for me when you discovered it.
Yeah, and those are the things that you kind of lose track of as the business grows sometimes, and so we started looking at what everyone was doing every day and assessing everything, and so we had this one role pretty much her whole time was spent in just filing our BOLs or bill of ladings that were shipped. Yeah, we did about 500 shipments a day, so 500 BOL, and she was still focused on filing them all in alphabetical order. And it was all fine. When we started, we were small. It was good to have our files in order, but she was still doing it when we had 500, and that was basically her shift. And there was really no use for it other than if we ever had to go back and find a copy of it, we then could easily find it. But at the same time, we now had a computer system. Everything was scanned in, so everything was on a computer. So there again, there was just no reason why we were doing it the way. So from there on, I said, box, cardboard box in the office, everything for one day goes into one box and write the date on it and and put it in the storage room. So we removed that role.
You imagine like a role that was probably, I don't know, 65 grand a year because the individual was spending 8 hours a day putting paper in alphabetical order, boxing it in when everything was already digitally scanned. And if you ever had to search it, you just needed to go to your portal, type in the search function, and you could print the copy that you needed. But we had someone doing 8 hours a day doing that function. So it went from 8 hours to like 10 minutes.
Yeah.
Yeah, it's crazy.
Wow.
But
That's
those,
like a make work project.
yeah, but those are the things that happen as businesses scale when they don't understand their economics, when they don't understand their activity, right? And so that's an example that I thought was good to share here. But thanks, Willie. Yeah, Alan, we'll pass it to you, and we'll go around. Maybe we'll open it up with you. What's the key learning from this call from you, Alan?
Oh yeah, we want to definitely do that. Let's not waste too much time on that. And so we're just go around the room, and if somebody wants to just go ahead and unmute and go first without being called on, that would be great. We've got, I'd love to know, what did you learn today? What was something new today, or a new understanding today, or a bit of an aha today? Maybe it's, you can go and look in the chat. I was trying to stay caught up on the chat. I put in all the 5 key numbers. Maybe it's, of the 5 key numbers, which one do you need to focus on right now? Or did something come to mind, when Hector gave us our challenge? Make one decision this week, implement that to, to improve your profitability.
That's a wrap for today's episode of The Inner Circle. If something in today's conversation resonated, inspired you, or gave you a breakthrough, please share it with someone you care about. The right idea at the right time can change someone's business and their life. So make sure you follow the show, leave a review, and stay connected with us, because this community is built on relationships, real support, and real growth together. Remember that clarity means nothing without action. So choose one insight from today, put it into motion this week, and notice the shift. Thank you for being part of this journey, for showing up for your growth, and for being part of the Inner Circle community. See you in the next episode, and let's keep growing together.